at all what the markets rely on. There is an underlying narrative that needs to be understood. Otherwise, if you don't understand what the present narrative is, what is the market following? What premise is it under? And market structure is not the be-all, end-all. It's not the panacea. It's not the answer to everything. Now, it does provide framework. I'm not going to deny that. Okay. And in fact, that's how I started teaching on baby pips back in 2010. I started with very basic, rudimentary ideas about market structure that I learned from Larry Williams. I later on learned, years after my introduction to Larry Williams' idea of market structure, which is nowadays prevalent in everybody's rip-off course, the idea of market structure. Okay. And when there's a market structure break, or when there's a shift in market structure, there's two distinctions there. Okay. Not everything is equal when it comes to market structure. There is classic market structure, and then there is institutional market structure. And I'm going to tell you and teach you exactly the difference between those two. Okay. The young man that runs this, I don't have a Instagram, otherwise I would have reached out and commented on here, and I'm not going to create an Instagram yet because I'm going to be creating one in March of 2022. Once I get my Instagram back in operation in March, I'm going to tag a couple people, and then I'll let you know what that account is, because I want them to be tagged. Otherwise, if they know what Instagram I have, they'll just block me, and it'll be just, falling on deaf ears. But at least everybody will see it. It'll be there, and then we can let the games begin. Now, with all that out of the way, let's get down to the nitty-gritty here. We're looking at the British pound, the daily chart, and I want you to think about how the ideas of support and resistance are, again, prevalent in retail. And the young man that operates that Instagram is pretty much a support and resistance kind of guy. And while that's fine, and support and resistance can work, now listen, it can work if you are in alignment with the present narrative. Now, what is narrative, and what's the difference between narrative and market structure? Well, if you look at price action like this, okay, market structure in its classic sense, well, if you look at this high here, this high being broken there, and if it comes back down in, that's a classic resistance, broken, turn, support. I don't subscribe to that. I don't subscribe to that at all. Now, I did in the beginning. When I first started in 1992, I felt that that was the answer. It's not. Now, there are times when the market will react to levels like that, especially if it's a higher time frame, like a weekly or a daily level. There's going to be some sensitivity there, but there isn't always going to be that higher time frame level to key off of. So you're going to have to use smaller time frames. Otherwise, you'll just sit on your hands a lot throughout the year and have very little trading. And I guess that's not a problem if you're predisposed to having a long-term perspective and analysis. But most traders today want to be in there either short-term trading or scalping, day trading, that type of thing, because it's the fast money game that everybody wants to be a part of. And maybe I'm guilty of, helping that movement, but that only matches my personality, really. If it doesn't match yours, then obviously it's not a good thing for you to do. But what is being shown here in this chart, we have an old high here. Notice the candles close here and then they open here. So we have this wick and we have this wick right there. Same thing here, small little wicks above it. When I'm looking at price, I'm looking at how the market reaches back into areas of liquidity. And most people will say, well, yeah, there's buy stops above this high. There's sell stops below that low. There's sell stops below that low. Buy stops above this high. And sometimes that's true, and other times it's not. I want you to think about price like this. Okay, I'm going to go into your settings on TradingView, go to settings, and go up to wicks and toggle that box. Take it off, and now you have this. When I'm looking at price, I'm looking at it initially with this perspective. I'm ignoring the wicks. I'm focusing on the bodies because that's the primary volume in each one of these individual candles. I'm not arguing that this candle didn't trade higher. Okay, during this interval on that day, yes, the British pound versus US dollar did in fact trade higher. I'm not referring to it after it's closed and moved away from it in the same sense. Now, there are times and there are things I'm looking for when I'm considering the wick, but right now I'm teaching market structure. Okay, and this is institutional market structure. That means your perception of price being support and resistance is not the same thing as the interbank. Those traders are not looking at the market through the lens of support and resistance. They're looking at it from two unique perspectives: liquidity and imbalance. That's it. Now, above these candles' bodies, there's going to be buy-side liquidity. That means buy stops. Anyone that's been short has a buy stop right there. Now, you might be thinking, who would have a stop when it's trading over here? Large funds, folks that hold a position long term. There's a lot of businesses that hold currency because they're waiting to do future transactions. So liquidity above here may not necessarily line up with the commerce end of the Forex, but there's going to be a large fund. Some entity will have a stop here or a buying interest above that high. Long-term trend models will look to buy above that. So when the market trades up there, notice what it's doing. The bodies go just above that old area where the bodies were here. It does not go above where those wicks were. It doesn't need to. The institutional perspective I'm showing you here is the market's reaching for that liquidity, just in the same way it did in a reverse. These bodies here, the market dropped down below that to accumulate all the sell side liquidity there. And then it rallies above to take the buy side liquidity here, and then ultimately there. Now, that's reaching for liquidity. That's institutional market structure 101. Institutional market structure 201, okay, the next level is imbalance. Now I want to go back to using the wicks for this. All right, so now we had this price run right there, and it goes above this candle's close, or the body of it. So we have a first run into that area, and it attacks that liquidity. When it creates this price run, what has it created in this particular candle? It's created an imbalance. What's imbalanced? It's moved one-sided, it covered a lot of ground, and it is one single large candle on the daily chart. So when this next candle here closes, we know that there's an area between this candle's low and this candle's opening that is primarily all one-sidedness. It's all buying. Now, if we look at this, and frame it in such a way where this begins the imbalance and this ends it. Well, if we start to trade down into that like we did on Wednesday, the likelihood is that we're probably going to trade down into this candle's high to rebalance. And I don't need it to trade back to this particular candle. Now I'm going to put it in for contrast. There you go. So it does trade to it, and that's fine. But I'm not looking at it that way. I'm looking at it from an institutional market structure. This needs to be rebalanced. If it's going lower, it's going to rebalance there. It just happens to have this old high back here, which would be classic market structure, where it retrades back to. Resistance, broken, turn, support. That's fine and great. I don't subscribe to that. What I'm looking at is the importance of this candle's high. Now, back on Baby Pips in 2010, I taught everyone to look at the daily highs and lows. And if you were to study those, you would start seeing these things as I teach it. Most students really drew no parallel to what I do in teaching and mentorship, and even on this YouTube channel, to those early days when I used to prompt everyone, look at the last 3 days high and low, and look at the open and the closing price. Because if you would have been studying that, you would have found the early observations that I had in 1992. So if you look at what's going on here, we're going to take this whole framework and drop down into an hourly chart. All right, so here's the hourly chart on the British pound. Now, if you're looking at this time frame, once we traded lower on this candle, when I see stuff like this and it comes right back up, I immediately disregard that wick. I don't care about it because it's running liquidity. What's it running? All the stops below these relative equal lows. When that does that and starts to trade down again, once we cross below it, that to me is a level that is not significant at all. It's insignificant. So it's irrelevant to me, and I block it out of my mind. So it would be the same as when I toggled off the wicks. I'm not going to do that here because I'm going to show you the importance of having those wicks now with what I'm teaching. But I disregard it. I pay no attention to it. Okay? The reason why is because this was a stop run and we went through it anyway. So I don't look at this low as a return back to that low because it's support, broken, turn, resistance, because you'll see here it never trades back to it. And this is the fallacy that classic support and resistance or classic market structure denies you access to what I'm going to show you here. Now, I talked about how the market reaches for liquidity, and I talked about how the market reaches for rebalancing imbalances. That's the institutional mindset. The key is understanding what the present narrative is. So is the market going down to rebalance, or is it going down to tag sell stops? It's doing one or the other. That's it. That's why the market's dropping. It's not because there's more sellers than buyers. It's not an absence of buyers. It's not selling pressure. It's the market's going down to rebalance and or going down for sell side liquidity or sell stops. The market doesn't care if you're in the position or not. It doesn't care if ICT is in the position or not. It's going to where the orders are going to be residing, period. If it is not going down to get sell stops, it's going to drop to go to a level to rebalance it. What is that? Well, once we broke this low here, what market structure from a classic perspective do you have to lean on except for this little area here? You have this stuff back up here. So what if it doesn't go up there? Do you miss this trade? Apparently so. But I don't miss those types of trades. I don't miss those opportunities because I understand the institutional mindset behind market structure. So let's go into a greater detail. This swing low here, what do you think was resting right below that? Sell stops. The market has rallied. Trailing stop losses could be positioned right there. We also have that same thing I described on the daily chart with that big candle, that big bullish candle. That's occurring right here. The same thing, but this is now a 1 hour candle. So there's an imbalance from this high to this low. It's all buying. So in this area, we have two things that the market from up here, once it breaks down, where is it likely to reach for? Well, there's an imbalance down here that it may want to rebalance and cover over top of this up close candle. The market will likely deliver a down candle into that range. Okay. It's also, conveniently enough, a sell side liquidity pool where there is sell stops resting right below that. They're pooling, they're converging, they're overlapping. Everybody has their same sell stop just below that low. If they haven't already trailed it up here and been stopped out, it's resting right below there. A lot of trending models on a fund level may be using this level for a stop. I'm not trying to make the case that I know who it is that has a stop there. It's irrelevant. But my eye has been trained to look for these swing lows, look for areas of imbalance, and under the pretense that there is a narrative underway that this market's likely to go down because we've left this consolidation. We've done so in decidedly sharp price decline. And now we have the opposite of this candle here and the opposite of the daily candle I showed you was an imbalance. We have that here with this down close candle. So when you see things like this, order blocks, market maker, liquidity zones, I don't know what a liquidity zone is, but liquidity, London breakout, I don't do those. But kill zones, voids, yeah, that's speaking from ignorance. And this imbalance, the market trades right back up into that imbalance then trades down. It does not go back to your classic support and resistance idea. It doesn't go back to any other market structure idea there. There's no turning point that it comes back up to. So why did it just stop right there and go down? And go right into that level right there and below that low. Now, some of you are sitting there thinking, yeah, this is easy for him to talk about this in hindsight. It's easy for him to say all this stuff now because it's already in the chart. Everybody's a genius in hindsight. That I admit. And early on, when you're learning anything, you have to learn from a hindsight perspective. But I want to take you into what I showed last night after I drop into the 15-minute time frame. But remember this little area for imbalance. We're going to drop into a 15-minute. All right, here's the 15-minute time frame. And the price drives up into, again, one single candle. That's an imbalance. It's all selling. So the market's wanting to go back up to that level to rebalance this. What is rebalancing actually referring to? Well, when the market delivers price and it's dropping to be efficiently delivered and offered equally, as it passed through that range of price, it will likely want to go back up in there because it gives the opportunity for anyone that wants to buy in this area, okay, in that range. Buyers may not want to buy at a higher price or at a lower price because they have a fixed interest in a specific price range, because they may be buying a currency or only willing to buy a currency at a specific price to do a transaction with another corporate entity. This is the part of the business that none of you really understand because you think it's just support and resistance, or you think it's, order blocks or market structure. It's not just that stuff. You have to have an underlying narrative understood and what the market's likely to do. Then you'll have a greater understanding, and then you can balance and complement classic market structure and now what I'm teaching you here, institutional market structure. So what's occurring here? The market's going right back up to rebalance all of this selling in here. Trades up into it, doesn't get into that old low, notice that, but then turns there, drops down, breaks these lows, comes right back up in, last up close candle. What is that? That's what I teach here on this YouTube channel. That's your bearish order block. Why is it a bearish order block? Because number one, it's acting inside of the narrative where it created a high, it broke lower, we ran sell side liquidity, came right back up into this level here. If I put a short-term overbought, oversold indicator, this area is going to be overbought. I don't need to see that. I know it's overbought because from this high and this low, watch, here, I'll show you. From this high down to this low, right there. If that's a range or dealing range that we're in present study of, if you're watching it live, from this high down to that low, when it was trading right there, how much has it covered from the high to the low? A large percentage of it, right? About 80% of it. Now, I'm eyeballing that. I'm not going to put the fib on. I felt inclined to do so, but I'll leave it to you to do it. But that's about 80, if not more, of a percentage from this low to high. It's retraced all that, and it went right above this short-term high. What is it doing? It's going after the buy stops. So the market's only going up from this low up to that high to take out the buy stops. Then it drops hard. And does it drop just to some random level? No, that's that level that I showed you perfectly. So when you see stuff like this joker, that's coming from a stance of ignorance. There is no umbrella statement that market structure answers everything. Structure is not structure. There's two different forms of market structure. The classic retail perspective that Larry Williams has really made popular, and what I have taught early on, and then what I understood later on after that, which is how the markets really book. It runs for liquidity or it runs to rebalance. That's it. It doesn't matter what your pattern or my pattern says. It doesn't matter what theology says about that particular market. Okay, it doesn't matter what the fundamentals are. Okay, it doesn't matter the opinion of CNBC's anchors. It doesn't matter what anybody says. It matters what the narrative is right now. Is it going lower to go down for stops or to rebalance? If that's not true, then it's going to consolidate or go higher. If you can't discern whether or not it's going to consolidate or go higher, then it's likely to keep going lower. So what is it going to reach for? Liquidity, which is sell side liquidity or sell stops, or it's going down to an area to overlap an area where one single candle stands by itself, and that imbalance will be the draw on liquidity. Okay, so let's go over to the video, and I'll close this one, and you can hear me actually talk about this whole business here and going down to them levels 18 hours ago almost now. Hourly chart, British pound. Again, disregard this wick here. So we have two areas of liquidity here and here. And finally on the cable 15-minute time frame, a lot of distortion when you have these wicks in here. So just kind of like imagine that this is not there. And we have a little imbalance there. We can see it trade up into that, but it could really just reach in here too. I like that better than just touching that, because that would be hitting this level but leaving the gap entirely open. I don't like that. I like the idea of coming up to it, just getting above this candle's high and rolling over it and getting that. Welcome back, folks. It's been a while since I posted another video to the YouTube channel, so I appreciate your patience and, as always, your continued interest in my content. All right, so we're going to talk about liquidity. I'm going to try to make this as brief as I possibly can. I tend to go overboard sometimes with insights and commentary, but I'm going to try to do it as short and concise as I possibly can, which invariably will always inspire questions, concerns. It will create gaps in your understanding, and that's normal. Okay, just know that it's meant for you to investigate on your own study, because I'm going to frame it in that capacity, so that way you know, while it's not just perfectly form-fitted for this example, students of mine for a long period of time will hear certain things that I've talked about in passing in other commentaries and other YouTube series videos that you can find on this channel. I'm not a pattern trader in the sense that I'm looking for, as it's commonly referred to as, a trading pattern like a harmonic pattern, okay, like a bat or a Gartley or a Fibonacci sequence. We're not looking for those things. So while I may reach for Fibonacci to show a level of projection and maybe show and highlight an area that is visually representing a valuation that would be undervalued or overvalued, or in the sense that it's overbought, oversold, without using an oscillator. Okay, we're looking at specific ranges. So I'm going to touch a little bit on my L7 ranges. Specifically in this lesson, it's going to be a 7 range example. And again, it's not trying to teach you everything, because there's no way I could do this, but it's also one more illustration of I haven't ran out of yeast. Okay, this baker has a lot of yeast, and I can continue to teach for decades in the future and still not run out of content, because I understand the algorithm. Now, what I'm going to show you today would be normally reserved for students that are in my mentorship, but I want you to appreciate the level of systematic delivery of price, why it does what it does, and try to just simply suspend your belief system on any other model or school of thought. Like if you're a supply and demand follower, or if you're an Elliott wave trader or a harmonic trader, if you trade market profile, all those things, just for a moment, try to put that to the side and try not to lean on any of your logic just for a moment. Okay, during the time of this recording, just suspend all belief in that. I'm not saying believe this wholeheartedly, but I want you to just listen to it and then go into your charts and you'll find it. Okay, so all right, so we're looking at the dollar CAD, and this is a pair. admittedly, I don't trade a lot, but if I don't get a setup in euro dollar or pound dollar, I will sometimes resort to trading this pair or the Aussie dollar. Okay, so I just want to toss that, the little disclaimer out there. I'm not actively trading dollar CAD a lot, but I want you to think about some general themes here. Again, I mentioned the L7 range theory, and it's basically trading inside the range. I'm going to frame a range for you so that we can see a little bit of the context that's required, but most of the things I'm going to show you here are pretty simple and straightforward, and it's not hard. It's not about moving parts, but there are very specific rule-based ideas that need to be considered when you look and study at old data, and you'll see that this occurs. When we're looking at liquidity, okay, the easiest way to determine that is anything that would reside above a short-term high or an intermediate-term high. Now you might look at this area here and say, which one's the high? Well, this candle is slightly higher than all of them, but whenever I see multiple candles or multiple levels that look very close to one another in height or in depth in terms of the lows, if we're considering the opposite in terms of looking for sell side liquidity, buy side liquidity rests above old highs. Now it can come in the form of these areas like this where it's relative equal highs. Okay, that's one of the concepts that I use to frame the idea and understanding of liquidity. Now liquidity can be formed on the basis of a single point of reference, like this high or this high or this high, or it could be a collection of relatively equal highs or relatively equal lows. Like this here, this would be considered relative equal lows in my school of thought. This is relative equal highs in my school of thought. This is a single buy-side liquidity pool, old high. This is a single buy-side liquidity pool, short-term high. These things, okay, are not required for a label sense. It's just, I'm showing you the contrast between the two, but generally anything above an old high would be buy side liquidity. That means there's buy orders up there. Now as a new trader, that sounds a little alien. It doesn't make sense. Who would be wanting to buy up there? Because your books are telling you buy low, sell high. There's always traders that are going short, or traders that want to buy on a breakout if it goes above that. So that's the context of why that's buy side liquidity. And I teach it from a institutional perspective. I'm not looking at it in terms of saying, this is a resistance level. I'm teaching that this is an area where there are willing buyers up there. And that perception of price action, once you start adopting that and looking at price with that view, your opinions, your bias, your analysis will slowly start to migrate away from the retail logic that all of us are indoctrinated with. When we first come into trading, that's a normal thing. But statistically proven, if you look at all of the retail logic that's available to us, why is it that 90% of the traders lose money? It's because the logic is flawed. Okay, so if it's flawed, what is the common denominator as to why retail logic fails more times than it wins? Now, I'm not saying it can't win. I'm not saying that retail traders always lose, and I'm not saying that a retail trader can't be profitable, even using retail logic. But they have to make a departure from all things retail. At some point, they have to inject their own experience into the analysis. And that experience is going to be a byproduct of looking at things experientially and seeing, okay, I've learned this pattern in the books. I've seen this author. I've seen this, educator or trader, guru mention this idea. But I've seen in this instance, when that pattern's there, it fails because of other things that I didn't learn in other books. And you're going to have these epiphanies. That's experience that you can't just get from a book. I can't transpose all of my experience. I can talk about things that I learned experientially, like what I'm going to show you here. But it's important for you to understand that the main common denominator is the markets are manipulated. And they're manipulated not on a random basis, but they're manipulated with a rule-based structure. So I'm going to give you a little bit of the details and how you can start looking for these types of signatures in price. So if you look at this dollar CAD, we have an old low here and price has rallied up. Now, Retail Logic states that we have this low as a support level. Why? Because price moved away from there. We don't go into describing why it would have turned there from a retail trader. They just deem it as, well, that's support because why? If price hits it and repels, then it's a support level. Okay, that might be simple enough for you to subscribe to. I don't look at it like that. I look at it as, okay, there is now engineered liquidity. Now, what does that mean? That means that the market has turned on a dime here and rallied higher. I see this as a liquidity pool of sell side orders. Okay, sell side liquidity. Anyone that would have an order below that would be a seller. They want to sell. Why would they want to sell below that? Because anyone that's long here or even chasing price, they're going to look back to this level and feel confident that, well, it bounced there before. So even if it starts to come down, which may be very uncomfortable for them, they have belief and faith and confidence that their books have indoctrinated them into believing that this is a level that should prevent price from going lower. And I used to think like that until I lost thousands of dollars. And then it quickly dawned on me that I'm probably not following the right things. So I want you to think about that low with the target or bullseye of the price wanting to go down to that level to attack the liquidity that rests below that low. Now, it may take months before it gets to this low, but if it gets to this low, this is what I want you to start looking at. And it doesn't only work on daily charts. This works on hourly charts. It works on 4-hour charts. It works on weekly charts. Okay, so it's important that you know that this liquidity idea I'm teaching you here is just part of the framework. But we can see eventually on the 9th of November, price trades down and goes below that low. This is an important event. When this day runs below this low, it's a crucial event algorithmically, because what it's doing is it's going into a pool of liquidity. Now, we don't know with any absolute assurity that what I'm going to outline here is going to unfold, but I'm going to give you the things you'd look for to build confidence that it is likely to. And you'll see by going through your own charts how fast you can see these scenarios developing. We're going to go down to an hourly chart and study this fractal where it goes below this low here. I'm going to release information to you that would otherwise not be shown on my YouTube channel. So let's go over to the hourly chart now. All right, so here is the hourly dollar CAD chart. Now right away, it probably doesn't look like much to you, okay? But I'm going to add the annotations in a moment, but I want you to take a look at some of the things without having any scribbles, any kind of annotations or markings or labels on the chart. And just let me flesh it out for you a little bit, and then we'll throw the lipstick on the chart. You should be able to see this high and this low as a important price range. Now, what makes it important? It's the most dominant price range in this portion of price action. So whenever I'm looking at price, I look for clear, discernible price ranges. When the range is clearly defined, as you can see here, what I do is I want to look for reference points based on measurements that are very generic. Okay, so in other words, I want to know what this high is here on this candle, and I want to know what the low of this candle is. Now, we're looking at this with the expectation that we're anticipating a run below that, but we don't know if it's going to continue. We wait for something to occur, which I'll outline here, and then once it happens, it gives us framework for short-term bias and where the withdrawal and liquidity is going to in an opposing order. In other words, we see an attack on sell-side liquidity with this day here. If something occurs, as I'll outline, that will be your green light to anticipate opposing buy-side liquidity to be taken. Okay, so the concept I'm showing you here is purge and revert. Okay, purge and revert. All right, so when we look at liquidity, you want to be able to look at it on the basis of daily highs and lows. Now, when you look at daily highs and lows, you can add period separators to your chart, like tradingview.com allows you to do. I'm not sure why it takes so long to load up like that, but there it is. But if you put the period separators on TradingView, this is the levels that you're going to get. Now, I'm not going to argue that what I'm going to show you is better or that you can't use this either. I'm just teaching you the way I look at it. Okay, so if you're here on my channel, that more or less indicates that you're interested to see how I think about it. You may not subscribe to everything I say. In fact, I would counsel you not to do that. There's things I'm going to say in this video and maybe in other videos that will be offensive to you because you are holding fast to your logic, your system, your method. And if it's profitable, don't allow me to change your mind about something that may be working for you. But if you can take something from the things I'm going to show you here and glean insight that may improve upon what you're already doing, that's really my only intention here. Okay, but it will be better if you could suspend all of the previous ideas that you have about price, okay, and looking for things. I don't do it like this, okay? So what I do is I look at the midnight to midnight time frame, and I delineate my session breaks like that. So it'll look like this. Okay, so all of my vertical lines here are midnight to midnight New York time. Once this low, which is highlighted with this line here, that's that old daily low. And we see that run below that old daily low here. That is a purging of liquidity. Now, once this purge occurs, we want to see the day of that purge. We want to start looking backwards, okay? And other video series and other videos and other commentaries I've done with Forex and trading technical analysis concepts and such, you'll hear this repeat. 3 days. Okay, I use a 3-day range of look back. Okay, if you look for the last 3 days, you'll have all the liquidity pools you need to make money. You'll have all the liquidity pools to target for your trades. You'll have all the liquidity pools that you could use for trade entries. And you don't need anything other than that. You don't need to have a IPTA 20-day look back period. You don't need to have a 60-day. You don't need to have a 40-day. You don't need to look back on your weekly charts and see how many times something hit a level 14 different times to have any faith in it. The market does not look back 20 years ago. The market does not look back 5 years ago. Okay? It looks at predetermined price levels, and that's the reason why the algorithms operate the way they do. And what do I mean by that? For some of you that are not technically inclined or familiar with computer programming, for those that are, this will make a lot of sense to you. But those that aren't, I'm going to just bear with me. For the folks that are technically inclined, I'm not trying to talk down to those individuals that aren't. I'm just trying to be as inclusive as possible and comprehensive, so that way you understand what I'm saying here, so it doesn't go right over your head. Because I can clearly see there's going to be a lot of people that are going to be confused by this lesson. But if you just take it for what I'm going to show you here and then go into your own charts, you'll see what I'm referring to, and then it'll click. So the day of the purging, in other words, the day it runs below that old daily low, when that happens, we count that as day one. Okay, that's day one of that event of purging. We wait to see if it goes higher and reverts, not reverses. Okay, I'm not saying reversal, I'm saying revert. What is it reverting to? It's reverting to buy side. So it draws to sell side liquidity, and that's counted as day one. That is day one, day two, day three. That's our look back on the day of liquidity purge. So the day it occurs, you look back 3 days. Now, inside the range prior to the liquidity purge, you got to look back and see where is that range. Now, you could have looked at this, say if you're looking at a 15-minute chart, maybe you would have seen it as this high to this low, and that's fine. There's nothing wrong with that. You would be just using 5-minute charts to get the same premise I'm showing you here on an hourly chart. It's all scalable, folks. The things that I teach are very friendly to making it your own. I don't mean that by saying take my content, rename it, and put a YouTube video up. Okay, that's not what I'm saying here. What I'm saying is it allows you the freedom and flexibility, because if the method and concepts are legitimate, it will allow anyone, any number of people to come in and form their own model, and which doesn't seem logical to a new trader or someone that's a neophyte, someone coming to this for the first time. Like it was for me, there only is one way of doing it successfully. And I've learned, it took me about 6 years to get there, but when I first started in 1992, it took me 6 years before I realized that there isn't one way to be profitable. There is a myriad of ways, but there are certain things that you need to understand that puts the odds more in your favor than if you didn't know it, and the adversities that you have and suffer through are really avoidable. Okay, you have to, at some point, you have to admit that these markets are 100% controlled. They are. You know, we have breakers in the marketplace that says once it trades this much, trading halts for a little while. Okay, isn't that a measure of control? Sure it is, and it's not limited to that. They know where these markets are going to go. They're driven there. Okay, and this is an example of engineered liquidity. Engineered liquidity is where they run down, take those sellers out of the marketplace. For what purpose? It allows individuals that are on the smart money side of things, informed traders, okay, large institutional traders, bank traders, and they will use that liquidity to be a counterparty to their buying. So it is a way of looking at price and saying, okay, I don't need to have an overbought, oversold indicator. I don't need to have a divergence in an oscillator. I don't need to have harmonic on my side. I'm just looking at where liquidity is. And if we see an old daily low taken, that is a significant pool of liquidity. There's lots of orders below an old low, like I indicated on the daily chart before transitioning to the hourly. But this event where it goes below that low, it's being paired with smart money that wants to buy. Now, right away, some of you are looking at this, oh, this is all hindsight. I'm teaching it through hindsight, but I promise if you go through your charts, the things I'm showing you here, they repeat over and over again, which is a basis for a model. This could be your unique trading model, and it's not really shown anywhere in any of my content. I don't even teach this even in mentorship. What I'm showing you here is fresh, but it's using concepts that I've touched on even in this free YouTube channel and in my mentorship. So I'm blending both of the worlds that are inside my mentorship and outside. I'm bringing them together with something for free right here, so that way you can gain a greater understanding of what the markets are doing and why they're doing it. If this is true, if my assumption and my argument that I pose to everyone that comes to me, if these markets are not 100% manipulated by an algorithm, then the things I'm going to show you here won't hold up. If price runs below an old low, that sell side liquidity has been purged only if we start to move away from it. Now, it might be a sweep on stops and then it continues higher, but if it runs below it and then goes back above a specific level, what level would that be? Well, we want to look at the day that it occurs and it runs the liquidity out. So this day here, I've annotated the daily high. If that high is traded to and through, that is a market structure break. Only on the basis of a liquidity purge. Now, it does not mean it's 100% successful. It just means that from an algorithmic standpoint, if we're looking at logical steps of processes, we look for this. If this occurs, then we look for this. If that occurs, then we look for this. And if that occurs, we look for that. So it's a matter of looking at a recipe for a model that would be unfolding dynamically. So if this day's high, when it takes the liquidity out, is broken on the upside here, I don't need it to close above it. I don't need that, because the narrative is it ran below an old low for liquidity. If it's going to go higher, the algorithm will start its macro, and macro is a short order of processes that begin and go step by step. And it's like a small little algorithm in a sense. And the large algorithm that creates and controls price action, it's just a bunch of smaller little algorithms that tie together. And it's very complex, obviously, but just know that you can reduce it to something as simple as what I'm showing you here. It may not seem simple right now because I'm a little wordy, but I need you to understand there's certain things that are at play here that cause these things, okay, that occur. So the run below the liquidity, if that day's high is broken, we see it here. Then we can start looking for buy side liquidity for the algorithm to revert to. Here's the previous day's high. That's all these little blind segments are. I'm looking at the daily high that is between 12 and 12 midnight each day. So this day's liquidity is taken out, but it's a break in market structure on the basis and narrative that we've taken sell side liquidity out. So now, once it does this, where do we anticipate price going to? Well, you first have to revert back to this high and this low. So we're looking at how much we're going to retrace from this low into this high. It may not ever get back to that high. And then here's the thing, you don't need to have it go there, but you need to know where the midpoint is. And that's what this level is here. So that's basically equilibrium between the high and the low of that obvious range. Now the algorithm knows this range high and it knows the low it forms here. The midpoint is equilibrium. So what we're doing is we want to look at 3 days back as far as, in terms of time, the liquidity above the daily highs as far back as day 3, and the filter is the midpoint or equilibrium of the range that it's traded in prior to the liquidity being purged. Now, I already know some of you, some of your ears are smoking right now. You're thinking, man, this is too much. I need a trend line right now. Somebody tossed me a moving average. ICT's killing me here. Trust me, okay? When you watch this video a few times and go into your charts, you'll see it. It's there. But the range needs to be filtered, okay? Once we get to the 50 point or 50% level of the high and the low, that's all I really use a Fibonacci for, folks. I'm just looking for equilibrium. And anything at or above it, in my mind, is expensive. In other words, it's a premium market. So it's going to require a whole lot more for me to be a buyer. And many times it will negate me being a buyer. But it will not disqualify a long entry that I have maybe entered and I did not. So we are clear now. I didn't take a trade on this. I'm just showing you conceptually how you can study and see these things going forward. But you can use these ideas to frame the logic on holding long positions or partials to get to this level and then day 3 in this case here. So what do I mean by that? We have the high, the low, the logic behind the run on stops on the sell side liquidity raid. Okay, so this is purged if we get a run above the day of the purging. And then we start looking at the previous day's highs, and above that is going to be liquidity until we get to the 50% level of the range. Once it does that, we are in an iffy, like it might not continue going higher. It could, but it might not. But if we have day 3 still in close contention with this level, in other words, it's not that far above it, and it's not a lot of range in terms of where the equilibrium is and where the previous day or day 3's high would be, that buy side liquidity would be potentially attacked. So we can see each day on the 10th of November, we had the break above the old high here. Market structure is broken. So now we're thinking buy side liquidity is going to be the next draw. That means your bias on a short term is look for this high to be tapped and maybe this one. We don't need it to go all the way back up here. Okay. We don't need to go all the way back up to the last up close candle, which is a bearish order block. Okay. You're looking at high probability. High probability. This is what this is. High probability short-term trading. So if we see that they're all on buy-side liquidity is the context that the algorithm is going to be operating under, they've already done the damage by going down. Traders are going to be looking for a continuation. They're going to be looking for bear flags. They're going to be looking for bearish Gartleys. They're going to be looking for bearish, anything to get them short. And supply and demand traders are going to be looking for supply zones to go short at. Traders that use simple support and resistance levels are going to be looking at, okay, well, we bounced here. Let's draw that out in time. And it might sell off here. And when it starts to go down like that, they get really excited. You thinking like this are thinking, well, we have a break in market structure. Your eye goes here, where their eye is looking for this level to be touched again because it's a support level. You see the paradigm shift that's taking place already in a short little video. Now, it feels long for some of you, but it's a very short window of time that I'm framing a mode of logic that repeats all the time on all time frames. But if we're going to use it in this context, using a look back of 3 days, then it's framed on a daily chart, and it can be reversed, obviously, if we're looking for runs above old daily highs. But look back is 3 days. Equilibrium is the high, the low, split in the middle. So all I did was, to get that level, you put a Fibonacci on this high to this low, and whatever the 50 level is, you annotate that on your chart. So each day after this day, you are looking for this pool of liquidity to be traded to and this pool of liquidity to be traded to. Once it does that, high probability goes away. It changes. Okay, so the algorithm goes into a different mode of delivery. It can become a deeper retracement, or it could accelerate into that high. That's not what I'm going to teach here. I'm not teaching that. And I know some of you are already, say you're holding back. No, it just requires a whole lot more to teach, and I don't have the time for it, and you wouldn't want to sit through it anyway. So each day, this high, being broken of this, creates the market structure shift. Buy side liquidity here, if we draw that out in time, and we're going to draw this one out in time. Okay, and this one here, because it's above the 3, and it's the last one. So if we continue with that bias, we'll see if there's any continuation of that logic reaching for buy side liquidity. All right, so now we have buy side liquidity here, buy side liquidity here, and buy side liquidity here. And we're going to look at the 11th of November, and we're going to look at that on a 15-minute chart. So let's drop down to the 15-minute time frame and look at this here and how it attacks these blue levels. All right, so here is the 15-minute time frame of that dollar CAD, and we can see the short little lines are always going to be individual daily highs. The elongated blue lines are going to be those old liquidity pools that we're looking for price to trade up into. So on the 11th, we have price trading in here. And again, all I'm annotating here is this candle's high, which makes that high. We don't use the midnight high when we're looking at all this data here. If this midnight candle makes a higher high, we don't call the 11th daily high that one, because it's really technically the 12th. So you're using only the data that makes the individual day prior to midnight in New York time. So the highest high and the lowest low, that's what we're looking for. But as soon as we get to midnight, everything starts new. That's a new range for the day. So we have equilibrium here. So we know the price could jump to that, or at least this level here. And this level is the initial one because it's below equilibrium, and it's the old liquidity pool on day 2. Look at how price trades back down in to this run here. Isn't this an optimal trade entry? Watch. Here's your swing low. All right, so here is the Fibonacci laid on that price swing. I'm using the bodies of the candles. Again, not using the wicks and the tails because the bulk of the volume is in the bodies. So it's going to give you a pure read on where the buy signal is going to be. All right, it doesn't mean that you can't use the wicks and the tails. It just means when I'm looking for optimal trade entry, I prefer to use the bodies of the candles because it will give you a pure read on the entry. If I'm looking at ranges, okay, like what I outlined on the hourly chart and showed you where the high was and the low was and then did the 50%, when I'm looking at finding equilibrium, I will use the wicks and the tails. Okay, I get a lot of questions, by way of email, and people get confused. Why does ICT use the wicks and sometimes the bodies? He's not consistent. It confuses me. I just answered that for you. Okay, the bodies are going to give me the pure entry point. The wicks and the tails are used just for measurement of ranges. Okay, so if I'm going to look for a pattern of entry, I'm using the bodies. If I'm looking for equilibrium measurements, then it's always going to be wicks and tails. Okay, when it comes to order blocks, that's a different theory, which I won't touch on here. But again, take for what you get. So we have the optimal trade entry in here. It trades down to that, and we have a standard deviation of -1/2, and it overlaps basically with that old liquidity pool. And then we have it trading up to